All right, Chapter 3, Recording Transactions in a General Journal. All right, Section 3.1 is on page 56. Your journals, your source documents, and recording journals in a journal. A form for recording transactions in chronological order is called a journal. Recording the transactions in the journal is journalizing. Page 57. You have an example in the orange box of what a general journal looks like. Information for each transaction recorded in a journal is called an entry. A journal with two amount columns in which all kinds of entries can be recorded is called a general journal. You want to be accurate. You want to put these in chronological order and date order. We're using double entry accounting, which means we're recording debit and credit parts. Each transaction affects at least two accounts. Source document is the business paper from which the information is obtained for the journal entry. And we have some source documents on page 58. A check, a sales invoice. Other source documents can be a receipt or a memo. You can have cash register tapes down at the bottom of page 59. Okay, and page 60 gives us an example of how we can record receiving cash from an owner as an investment. And a receipt is going to be the source document. The steps are on page 60, steps 1 through 4. Page 61, pay cash or supplies. You have your T accounts that are shown and how this transaction is recorded in the general journal. You have the steps, bottom of page 61. So let's walk through these steps by doing 3.1. A journal is given to you. Norm Derner owns Derner Copy Center, and you have the following accounts. Again, I use the book. If you click right here, you have your instructions where you don't have to use the book, but it's too hard for me to do this recording, so I just read from the book. April the 1st, you received cash from the owner as an investment, $1,500, R1, receipt 1. So your date is going to be April the 1st. Okay, you received cash, and you have to just know that the debit goes first, and the cash will be debited. Receipt 1, and all of this we learn as we keep going through these transactions, $1,500. Okay, we received this from Norm Derner, and we're going to use the capital account because he invested $1,500 into his business. On April the 2nd, paid cash for supplies. So April the 2nd, paid cash for supplies. Supplies is an asset account. We paid cash for the supplies. We increased our supplies, so supplies will be our debit. And we paid cash, so that was check 1. And we bought $375. So that's going to be shown as a debit. We paid cash. Cash is an asset account, and we reduced cash. So we have to credit our cash account $375.